I'm Gene Goldman, and here's a look at the week ahead for the week of March 27th. Well, despite the Fed raising rates last week and the lingering concerns around global banks, which in theory, both of them push us closer to a potential recession, stocks were positive. The benchmark S&P 500 was up 1.39% last week. We did see a lot of market volatility. As an example, you look at the 2-year Treasury yield, which we talked about before, is a proxy for the Fed funds rate 1 year from now. On Wednesday, it hit a high of 4.26%, but then by Friday, it was all the way down to 3.44%. What this says to us is that the bond market says a recession is coming and the Fed will likely need to cut rates later this year. So why have we seen all this increased market chatter around a potential recession? There's 2 reasons. Number one, the Fed. The Fed is raising interest rates, and there's worries that the Fed will break something. And rightfully so, the Fed has made mistakes. If you look at the last 15 rate hike cycles, 11 of the last 15, the Fed has made mistakes and pushed us into a recession. The Fed raised rates last week, 1% and they did indicate that they expect to raise rates one more time this year and then hold rates steady through year end. But if you look at the slide here, the markets expect something different. The markets expect the Fed to start cutting rates very soon. The markets are anticipating the Fed puts us into a recession and they are forced to cut interest rates. The second reason in terms of why we're hearing more about a potential recession is that this banking crisis increases the chances. You see here that banks are borrowing more from the Fed's discount window. And the Fed's discount window is usually used by banks when there's market stress or when getting funds from elsewhere is very difficult. What the banks do is that they go to the discount window, they get cash in return for providing collateral, like securities, like government bonds. With signs that banks are accessing this more, lending is likely slowing, and this is likely leading to tighter lending standards. You look at this slide here. This slide shows that lending standards were already tight going into the end of last year, and it's probably increasing during this current banking crisis. All of this potentially turns into a credit crunch, which makes it harder to borrow money, which therefore leads to a potential recession. So this week, we will see further data to gauge if we are headed towards a recession. With consumers representing about 70% of our economy, we get some very important readings. On Friday, we get the February personal income, which is expected to slow from 0.6 to 0.3%, and then spending is expected to drop from 1.8% to 0.3%. We also get the University of Michigan consumer sentiment, the final reading for March. This will give us some perspective in terms of how the banking crisis is hurting consumer confidence. The number expected is 63.4. The overall takeaway is that markets are worried. There's lots of uncertainty. The concerns about banking. Will the Fed raise rates further? Will all of this push us into a recession, faster or a deeper recession? We at Cetera continue to believe if we have a recession, it will be a mild recession. You can look at the strong labor market. You can look at housing is not like 2008. You can look at what we call a rolling recession, a mild recession. We are releasing our market outlook this week, and we expect a so-called soft landing, a very mild recession. Thank you for listening. For more information, please follow us on Twitter at CeteraIM. See you next week, and thank you.